How to invest like the rich. That is exactly what I'm going to share with you guys today. I'm going to take you through exactly how a rich person invests. And for today's example, a rich person is someone I'm classifying that has $10 million more in assets than liabilities. So they have a lot of money behind them, guys. I'm going to share with you exactly how they invest. And at the end, I'm going to share something that's probably going to shock a lot of you guys out there. So that should be very interesting. So the first way the rich invest, they really think about real estate, okay? That's their first main way of investing. They're thinking about real estate and what do I do with real estate. Now, what the rich do, they don't like flip properties very often. They're actually not even very interested in renting out properties. What the rich do a lot of times is they buy and hold, okay? They buy a property and they hold that property and they hope it appreciates over time. Now, the markets they love to do this in is LA, especially Los Angeles. They also love to do this in New York. There's a few other markets, you know, London, they love to do this in, Toronto, a few other markets around the world that they love to do this, but LA and New York are definitely the main ones, especially for Americans, that they love to just buy a property and hold it. And as their wealth increases, they'll buy another property and hold it. And then when the time comes and they feel like they want to sell that off, they can sell that off. If you looked at how much prices have gone up in Los Angeles and New York over the last few decades, it's a dramatic increase, guys. So a lot of these people, you know, they'll pay $2 million for a house. When they're 40 years old, they'll buy it. You know, they'll pay $2 million for that house. When they're 60, they can go ahead and sell it for $4 or $5 million. It's a dramatic increase, guys, because those markets just keep increasing. For whatever reason, a lot of people love to live in those places and demand just keeps going up and whatnot. So that's the main way they love to invest in real estate. They just buy a property, they hold it. They don't even care to rent it out. That's why a lot of these, you know, rich people, you'll see their house and it's vacant 6 months out of the year. They're not even there. No one's using it. They're not, and you could say, well, they could be making money, and yeah, they could, but a lot of them just don't care about it. They just want to buy and hold. They don't want to deal with the whole rentals and all that kind of stuff, okay? The second way they love to invest is stocks, okay? But they do stocks a little bit differently than the average person, okay? So with stocks, what they're really thinking about is they really want to invest in dividend-paying companies, okay? They're really looking at dividend-paying companies. They're not really looking to kill it in the stock market. The same thing, they're not looking to kill it in real estate. They just want to make their more money into more money over time, and they don't want to take a super lot of risk, okay? So they'll invest in bigger companies that pay dividends, okay? A 2, 3, 4% yield. So you say, well, if the stock market on average goes up around 8% a year, then they can hopefully get their 8% a year on that stock as long as they picked a decent stock, right? And they get their dividends on that. Also, they're usually very diversified. They're not in just like 5 or 10 stocks. A lot of times these guys are in 20 to 30, if not more stocks than that. And generally they all pay dividends, okay? So that is another way they love to invest. The third way they love to invest is not even really investing in my opinion, but they love to take out long-term CDs, okay? They love to take out long-term CDs. So this is a banking move you can make, and when you have a lot of money already and you take out a long-term CD, you can get actually a much higher rate than someone can that is actually just kind of going to the bank and maybe has $10,000 to put in a CD. If you look, usually the banks will give a higher percent the more money you have, okay? So these people on a long-term CD, that's like a 5-year CD, right? You might be able to get 4, 5, 6% on their money, which is dramatically more than someone that goes in there with $1,000 or $10,000 looking to open a CD. So that's another way they love to do it, a certificate of deposit. Like I said, it's not really like investing because that money is usually guaranteed by the bank. It's not like you can lose that money or something like that generally. So those are the 3 main ways they want to do. They want to do real estate, they want to do stocks, they want to do long-term CDs. And even the way they spend their money a lot of times is different. For instance, I can always tell someone that's kind of new to money and just kind of getting money for the first time and someone that's been rich for a while. Because people that have been rich for a while, they usually buy Ferraris as far as a lot of their exotic cars. You'll see a lot of people buy Ferraris. Why do the people buy Ferraris versus like Maserati or something like that? Well, because Ferraris hold their value much more. Ferrari actually does a lot of things as far as cutting the production, so there's always way more demand for Ferraris than what they have as far as what their amount they're producing and whatnot. So you can always tell someone that's been rich for a while versus someone that's new to money, because the ones that have been rich for a while, they know to buy Ferraris. Some of the other ones, they buy Maseratis, some Lamborghinis, and some of the more high production type cars, okay guys? So that's a way. Now, okay. Now I'm going to share something that's probably going to shock some of you guys out there, and you're going to say, what the heck? And what I'm gonna say is this whole idea is really stupid for most people, okay? This whole idea of the way they invest is a really dumb way for most people. Why is this? Because most people aren't rich. So you have different goals in mind when you are rich versus when you are not rich, okay? There's different goals. When you are rich, okay, you got 10 million plus in the bank, you got a lot of money, your number one thing you're kind of looking for is to preserve wealth, okay? Your number one goal is to preserve that wealth, okay? It's not to make more wealth. When you're not rich, okay? When you're not rich, your number one goal is to make wealth, okay? So your goals are dramatically different. So the way that you preserve wealth and the way you make wealth, they're very, very different, guys. They're very, very different. First off, if you're thinking about, if you're not rich, okay, and you got, I don't know, $100,000 in the bank or $50,000, you can't even buy a property in Los Angeles or New York. So that whole option of buy and hold real estate properties in some of the hot markets, that's not gonna work for you. Also, getting into dividend companies, you can get way better gains and a lot of the other companies out there that don't pay dividends because they're higher growth and things like that. So when you're trying to make your wealth, guys, a lot of these ways that the rich take advantage of and do it, it just doesn't make sense for if you're trying to make wealth. So a lot of people think, oh, I got $20,000, I should invest like rich people. No, you shouldn't. You should invest like someone that's trying to create wealth. The way that a lot of these people made their wealth, they didn't make their wealth because they were investing in real estate long term. They didn't make their wealth because they were getting into dividend stocks. They made their wealth a lot of times because they worked the corporate ranks up and they got rich from that, or they invested in the right company, one company, and they got rich. Think about all the people that invested in Facebook early on and Twitter and a lot of these big companies, or happen to work there and they got a bunch of stock and then they, could cash out with $20 million, $50 million. Think about those type of people, entrepreneurs that created businesses that they went ahead and sold or they still run to this day. That's how people get rich, or maybe they just inherited their wealth. Their parents are rich, probably from starting a business or investing in the right business or something. So you get rich very differently than preserving wealth, okay? You got to just kind of change your mindset around that. The way you preserve wealth and the way you make wealth is very, very different, guys. And at the same time, if you're super rich, a lot of times it's kind of dumb to invest like someone that's not rich, okay? For instance, if you got, $100 million in the bank, it doesn't make sense to be in 2 or 3 or 4 stocks. That's kind of super risky, right? Because what if you lose a massive amount of money and then you go down to 10 million or 20 million? Is that really the smartest thing to do? No, you already have so much money. You've already built so much for you and your family that at that point, it's not worth the risk a lot of times, unless maybe you can take out loans, which maybe you can take out the loan where it doesn't come back to you. It's non-recourse to you. It just comes against the business. And if the business that you're starting fails, then the money just kind of like evaporates and just, you get hit on that, but you don't get hit as far as it coming against your personal assets. You could do things like that, which is a lot of what the massive, wealthy people do, is they'll actually take out loans, they'll take out debt to start some kind of business or do something where they'll start this business, right? And the debt actually is non-recourse to them. So although they might have $100 million in the bank, if that business fails, if that business goes bankrupt and those loans are defaulted, it cannot come back against that person. It cannot take their $100 million in assets and things like that, guys. So it's a very different how the rich use debt versus how an average person uses debt, guys. So that is how you invest if you're already rich. But at the same time, like I said, guys, it doesn't make much sense to invest like that when you're not rich, because it's you're never going to get there unless you're like 70, 80 years old and you want to be rich. And who the heck wants to be rich finally at that age? Like, you want to be able to enjoy your whole entire life. You want to be able to enjoy your 30s and 40s and 50s and 60s and all those ages in between, guys. So I hope you enjoyed this today. I hope this video enlightened you. I hope you got a ton of value out of this. Make sure if you're still watching this video, you click that first link in the description. That's my stock market investing mastery course that goes into every single thing that I look for in a stock. It even has my private email address that you can contact me if you have any questions regarding the course. Thank you for watching, guys, and have a great day.